Stop staring at red candles on a screen in New York. Stop listening to analysts telling you the dollar has been saved. And stop panicking because silver briefly dipped to $83. Because while everyone is focused on paper price action, the real move is happening somewhere else. The checkmate move is happening in Beijing. The United States thinks it won a battle yesterday by smashing prices. China is preparing to win the war by flipping the entire board. It's Tuesday, February 3, 2026, and the most important story today is not the price of gold or silver. It's an article just published in CHECKMATE, the official theory journal of the Chinese Communist Party. Now pause right there. Why should anyone in the United States care about a Communist Party journal? Because CHECKMATE is not opinion, it is policy. When something appears there, it reflects the thinking and direction of President Xi Jinping himself. And this article wasn't written to discuss abstract philosophy. It was written to issue instructions. Specifically, instructions to China's financial authorities. In this article, President Xi states clearly that China must build a powerful currency capable of challenging US dollar dominance. He calls for accelerating the international use of the yuan. But he goes further than that. He directly links currency strength to national financial security. That matters, because what he's really saying is this: currency is no longer just economics. It is strategy, it is defense. This is China signaling that the dollar-centric system is no longer acceptable, and that a new framework is coming, one built on credibility, reserves, and hard assets. And the timing is not an accident. Why publish this less than 24 hours after U.S. banks slammed gold and silver prices? Because Beijing understands exactly what that move was. It was not strength. It was stress. A paper smash is a defensive move. It buys time. It does not solve the problem. China knows the U.S. defends its currency with debt, derivatives, and leverage. China is preparing to defend its currency with something else entirely. Assets that do not default. Assets that do not rely on confidence. Assets that settle the argument. That's why this article is being widely viewed as a precursor, not the event itself. Reports out of Shanghai suggest preparations are underway for a major update to China's official gold reserve figures. For years, those numbers have barely moved on paper, despite massive physical inflows that analysts have tracked through imports, refiners, and vault activity. In other words, what China says it has and what China likely holds are two very different things. If those reserves are officially revalued or disclosed at scale, it changes the conversation overnight. Not because it crashes markets, but because it resets trust. This is not about tomorrow's price. It's about the system you wake up in 5 years from now. So don't let short-term volatility shake you out of the bigger picture. Don't confuse noise with signal. The signal today didn't come from a chart. It came from Beijing. And when policy speaks before markets move, history tells us one thing: the market always catches up later. We track imports through Hong Kong. We track domestic mine production. We track refinery throughput. And when you add it all up, the official numbers fall apart. The real figure is likely 10 times higher than what China admits publicly. For years, they have been stockpiling thousands of tons of gold off balance sheet, not in the central bank's headline disclosures, but under the State Administration of Foreign Exchange, state-owned banks, and military-linked reserves. Quiet, deliberate, unannounced, they've been accumulating in the shadows, waiting for the right moment to show their hand, and that moment is now. Picture the setup. U.S. markets are unstable, debt is pushing $38 trillion, confidence is fragile, and then China steps to the podium. No tanks, no missiles, no threats. They update a spreadsheet. They announce that instead of holding roughly 2,000 tons of gold, they actually hold 30,000. In one sentence, the world changes. Suddenly, a currency block exists with more physical metal backing it than any monetary system in modern history. And in that exact moment, the US dollar doesn't weaken, it breaks. Not slowly, not gradually, instantly. And gold doesn't rally. It reprices. There is no discovery process. There is no debate. The price doesn't climb from 4,900 to 6,000 or 7,000, it jumps. 10,000 overnight is not speculation, it's math. The market realizes that price suppression was enforced by a heavily indebted system, while value was quietly accumulated by a solvent one. This is what a financial military parade looks like. Just like rolling hypersonic missiles through Tiananmen Square, this move isn't about use. It's about visibility. It's about signaling power without firing a shot. The message to Washington is simple. You can smash paper prices, we own the metal. Checkmate. And here's the part nobody wants to admit. The United States helped them do it, by slamming gold and silver prices yesterday, by forcing that artificial drop to $83 in silver. Western banks handed China a gift. They put strategic assets on clearance sale right before a potential reveal. China didn't panic. China bought. Every ounce leaving London, every bar draining out of New York, it's being absorbed, not for speculation, for foundation. This is how a new currency system is built, quietly, methodically, physically, so don't get distracted by noise. The paper smash was a smoke grenade. The real movement is happening behind the lines. While the West plays checkers with leverage and derivatives, China is playing go with bullion. And there's a specific mechanism driving this drain. A mechanical reason Western vaults are bleeding metal right now. We need to talk about David Jensen. We need to talk about the $34 arbitrage gap acting like a vacuum cleaner for global silver. And you don't need to be a geopolitical mastermind to understand what's happening. You just need a calculator. There is one data point right now that has bullion banks sweating through their custom suits. We need to talk about David Jensen. David is one of the very few analysts who tracks the plumbing of the silver market, not paper contracts, not futures positioning, physical bars, real movement, vaults in, vaults out, and he just published a number that should be flashing red on every trading desk in London and New York. He's identified a vacuum so powerful that it is pulling physical silver out of the Western system at a rate that is mathematically unsustainable. This is the Shanghai arbitrage. Right now, the price of silver on the Shanghai Gold Exchange is trading at a massive premium to London and New York. The paper smash in the US pushed silver down into the mid-80s. China didn't flinch. Chinese buyers are paying roughly 29% more just to secure physical metal. That is about $23 per ounce above Western spot. And it gets worse for the Western vaults, because silver entering China is subject to a 13% value-added tax. When you add that VAT to the premium, the replacement cost inside China explodes. The effective price of silver inside the Chinese border is now roughly $36 above Western prices. $36. That is the gap. That is the spread. Now let's talk logistics. What does it cost to move silver from London to Shanghai? Secure transport, insurance, armored air freight. About $2 an ounce, maybe $2.50 if you want it fast. So do the math. $36 in spread minus $2 in shipping. That leaves a $34 profit per ounce. Risk-free. In finance, this is called free money. If you are a bullion bank, a trading house, or a miner, why would you sell silver in New York at $86? Why would you sell it in London? You wouldn't. You palletize it, you load it on a plane, you fly it to Shanghai, and you sell it near $120 an ounce. That's a 40% return on a 12-hour flight. There is no better trade in the world right now. And that's the vacuum. That's the sucking sound pulling metal out of Western vaults. Not speculation, not conspiracy, just arithmetic. Water flows downhill. Capital follows incentives. Metal moves to where it is valued. And right now, silver is being valued in the East, not the West. Capital always flows to the highest return, and silver flows to the highest bidder. Right now, China is the highest bidder by a mile. They are effectively offering a $34 bounty on every ounce of silver on the planet. The message is simple. Bring it to us. Drain your vaults, empty your ETFs. We will pay you. And the Western banks are doing exactly that, because they are arbitrage desks, not patriots. They don't think in terms of national security, they think in terms of quarterly bonuses. So they are emptying LBMA vaults in London. They are pulling metal out of COMEX vaults in New York. They are liquidating the West's strategic industrial inventory to capture the spread. Every single day this arbitrage exists. Physical silver leaves the dollar system and enters the renminbi system. And here's the key point. Once silver enters China, it does not come back. China does not export silver, it absorbs it. It goes into solar panels, it goes into electronics, it goes into defense systems, and it goes into the foundation of the powerful currencies Xi Jinping just ordered. This is why the paper smash was not just ineffective, it was a strategic disaster. By pushing silver down to $83 or $86 in the US, Western banks widened the arbitrage. They made the trade even more profitable. They turned their own vaults into a clearance sale for their biggest geopolitical rival. They thought they were defending the dollar by painting a scary chart. What they actually did was subsidize China's accumulation. It's like selling the family farm to make the minimum payment on a credit card. And Washington knows it. They are not blind. They have satellites. They can see the cargo flights. They know that if this vacuum continues for another few weeks, registered silver on COMEX goes to zero. They know what that means. A physical failure, a delivery problem, a credibility collapse. That's why panic is starting to creep into Washington, D.C. That's why, suddenly, the Secretary of State is holding emergency meetings on critical minerals. That's why strategic language is replacing market language. They are realizing something uncomfortable. The free market is eating them alive. We need to talk about Marco Rubio. We need to talk about the emergency summit scheduled for tomorrow, because while bankers in London are counting their $34 arbitrage profits, the mood in Washington has shifted from confidence to concern to fear. The United States believed it could run the world on paper contracts. They forgot one thing. You cannot build a cruise missile with paper. You cannot build a microchip with a futures contract. And you cannot maintain power without physical control of the materials that make the world work. You need the metal. And right now, the metal is leaving. That's why if you check the State Department calendar for tomorrow, Wednesday, February 4th, 2026, you'll see an event that looks dull on the surface, but is anything but. Secretary of State Marco Rubio is hosting the inaugural Critical Minerals Ministerial in Washington. He's bringing in ambassadors and trade ministers from Europe, Japan, South Korea, Canada, and Australia. The official press release says the goal is to strengthen and diversify critical mineral supply chains to support economic resilience. That's diplomatic language. Here's the translation. China is taking everything, and Washington needs help. This is an attempt to build a NATO for metals, a coordinated bloc to slow or stop the Chinese vacuum that is pulling strategic resources out of the Western system. They are responding to the same data David Jensen laid out. They see the $34 arbitrage gap, they see the metal leaving, and they understand something critical. Silver is no longer just a monetary metal. It is the oil of the 21st century. You cannot build a green energy system without silver. Solar panels rely on it. You cannot build advanced AI hardware without silver. High-performance chips need it. You cannot maintain a modern military without silver. Missiles, fighter jets, satellites, guidance systems, they all require it. And here's the problem. The United States consumes roughly 5 times more silver than it produces. We are structurally dependent on imports. Mexico, Peru, the global market, and China is currently bidding that market away from us with a near 30% premium. Rubio knows the math. If this arbitrage continues, and registered COMEX silver drains out by March, the consequences aren't theoretical. Defense contractors start missing deliveries. Supply chains stall. Lockheed Martin calls the Pentagon and says they can't source silver paste for guidance systems. That's not a market issue. That's a national security crisis. So tomorrow's meeting is not a trade summit. It's a war council. The goal will be to pressure allies into coordination, to restrict exports, to limit access to strategic metals for non-aligned economies. That means China. They will likely float measures to disrupt arbitrage. They may discuss export controls. They may even quietly raise the idea of capital controls on strategic metals. In plain terms, the message would be, you can't ship silver to Shanghai anymore, because Washington has finally realized something it ignored for decades. Paper control does not equal physical control, and you cannot defend a nation, power a future economy, or win a geopolitical contest without the materials that make modern civilization work. A matter of national defense. That's how Washington will frame it, but here's the problem: it's too little, too late. You cannot legislate away the laws of economics. You cannot block a river with paperwork. As long as silver trades $36 higher in Shanghai than it does in New York, the metal will move. If you ban it, it gets rerouted. If you restrict it, it gets relabeled. If you regulate it, the black market fills the gap. Third-party nations will buy it from the United States and quietly resell it to China. Smugglers will handle the rest. There is only one way to stop the drain. The Western price has to rise. New York has to come up to Shanghai. $86 silver cannot exist in a $120 world. The suppression has to end, because the math demands it. This meeting tomorrow is not a show of strength. It's an admission of defeat. It's the U.S. government acknowledging that a market it claims to support is now exposing the damage caused by years of price manipulation. They pushed the beach ball underwater for too long. Now it's coming up fast, and it's hitting them in the face. Rubio is trying to hold it down with policy. That won't work, and the market knows it won't work. That's why yesterday's paper smash failed. That's why the psychology didn't break. That's why price is already fighting back. Traders can see the desperation. And desperation is never bullish for control. When governments start holding emergency meetings about supply chains, it means the cupboards are empty. And to understand how bad this really is, you have to stop thinking like a trader and start thinking like a physicist. Markets obey laws just like nature does. Water flows downhill. Capital flows to where it is treated best. Commodities flow to the highest bidder. You cannot negotiate with gravity. You cannot regulate it away. And right now, the United States has created a gravitational singularity in Shanghai that is swallowing the world's silver. Think about the irony. The U.S. Treasury and its banking partners spent billions in paper derivatives yesterday to smash silver down to $83. The goal was to protect the dollar, to make fiat look strong and metal look weak. Instead, they did the opposite. They made silver cheaper for their biggest rival to buy. They widened the arbitrage. They accelerated the drain. In trying to save the dollar, they committed one of the greatest strategic blunders of the modern financial era, and the consequences are only just beginning to show. Since the Maginot Line, they accidentally put the most critical strategic asset of the 21st century on clearance sale. They hung a giant neon sign over the COMEX vaults that said, "Everything must go, 30% off." And China didn't panic. China didn't sell. China said, "Thank you very much." They backed up the trucks. What we are watching right now is the great migration of physical capital. Armored trucks are leaving warehouses in New York and London, heading to airports, loading pallets of 1,000-ounce bars onto cargo planes bound for the east. And those bars are not coming back. They are leaving the LBMA system, the heart of the Western fractional reserve model. And they are entering the Shanghai Gold Exchange, which is a physical-only fortress. This matters, because once a bar enters the SGE, it is melted, reassayed, and restamped with Chinese markings. It is removed from the Western ledger. It cannot be rehypothecated. It cannot be redelivered against a New York futures contract. It is gone, forever. That is the tragedy here. The United States is selling its insurance policy to its largest geopolitical rival at a discount. Silver is not just a commodity. It is insurance against currency failure, insurance against conflict, and the raw material required to build the next economic system. And we are shipping it to Beijing because a trading algorithm in Chicago decided the price should be lower. We are arming our competitor to protect the optics of a stock index. And the scale of this migration is what should scare you. Silver normally moves slowly. Bars sit in vaults for decades, untouched. But right now, the velocity of metal has exploded. Swiss refineries are running 24 hours a day, 7 days a week, not to process new mining supply. Mines are already stretched thin. They are melting Western good delivery bars. Bars stamped with United States Assay Office. Bars that represent decades of accumulated strength. They are being erased, melted down, and converted into kilo bars for the Chinese market. We are literally dissolving our own monetary history to build China's future. And who is facilitating this? The bullion banks, the trading houses, the JP Morgans, the HSBCs. They are chartering the planes. They are executing the trades, not because they are villains, but because they are incentivized. If the spread is $34, they are obligated to capture it. That is their business model. They answer to shareholders, not to national security advisors. They don't care who ends up with the metal. They only care that the trade clears, and that is the core failure here. When national survival collides with quarterly profit, the market will always choose profit. They will drain the last ounce of silver from a New York vault if it turns a profit. They would sell the copper wiring out of the Empire State Building if the arbitrage were wide enough. And right now, it is. So when you see the price dip on your screen, don't interpret it as lost value. See it for what it actually is, a liquidation event. The West is liquidating. The East is accumulating, and the vacuum is emptying the room. Nature hates a vacuum. Pressure always equalizes, and eventually, the vaults in New York hit zero. And when that happens, when the last bar is loaded onto the last plane bound for Shanghai, the game of musical chairs ends. The music stops, and the United States looks around and realizes it doesn't have a chair. It doesn't have the metal. At that point, Rubio's critical minerals summit won't matter, because you cannot regulate what you no longer possess. This is where price becomes unavoidable, because the market is smarter than the government. The market sees the trucks leaving. It sees the planes taking off. It understands what desperation looks like. That's why the price didn't stay down. That's why the crash failed. We need to talk about the recovery, about the move back through 86 and what comes next, because the squeeze is still alive, and when it resolves, it won't be gradual. But the real proof that control has been lost isn't in diplomatic statements or arbitrage spreadsheets. It's in the price action. Yesterday, they threw everything at this market. They rolled out the Kevin Warsh narrative. They pushed the deflation scare. They dumped billions of dollars in paper shorts to smash silver down to $83. It was shock and awe. It was designed to break confidence, to force capitulation. And normally, after a hit like that, markets stay down. They bleed for weeks. Bulls retreat. Momentum dies. But look at the screen today. It's Tuesday. The sun is up. And where's the price? Silver is not stuck at 83. It's not rolling over. Silver ripped back above 86. Gold reclaimed 4,900. The Warsh crash lasted less than 24 hours. They fired their biggest weapon, and the market barely flinched. That tells you everything you need to know. When bad news can't push price down, it means the sellers are exhausted. It means the underlying force is stronger than the suppression. This is not weakness, this is absorption, and absorption always comes right before the move everyone said was impossible. That's the signal. It tells you the dip buyers are now stronger than the paper sellers. It tells you the market figured it out. The crash was fake. Traders looked at Shanghai, which never crashed by the way, and immediately understood what happened. New York wasn't discovering price, it was giving away inventory. They saw the $34 arbitrage gap, they saw silver at 83, and they knew it was mispriced, so they bought it aggressively. That is the definition of a failed suppression, and in technical terms, a failed move always leads to a fast move in the opposite direction. When you try to hold a beach ball underwater and lose your grip, it doesn't rise slowly, it explodes. That's what we're watching now. The shorts who sold yesterday were betting on $70 silver. They sold the bottom. And now price is back above 86. They're trapped. Every tick higher, 87, 88, 90, forces them to cover, forces them to buy back what they sold. That buying pressure is the fuel. That's how squeezes work. The war shock was supposed to end the bull market. Instead, it confirmed it. It proved that even with the full weight of the U.S. government and the banking system pushing down, silver could not be held below 85 for more than a single day. That's not random, that's a floor. And if 85 is the floor, the ceiling isn't defined by charts anymore, it's defined by physics. Now look at the physical market behind this bounce. While paper prices were whipping around, Shanghai never blinked. The Chinese market didn't care about Kevin Warsh. They don't watch cable news, they watch volume, and volume on the Shanghai Gold Exchange is exploding. Metal is leaving the West constantly, methodically. That means New York prices have only two options: rise to meet Shanghai, or lose the metal entirely. There is no third option. Unless silver trades near $120 in New York, the arbitrage stays open. And as long as it stays open, the drain continues. So this price rise isn't speculation, it isn't hype, it's necessity. It's the only mechanism left to stop the bleeding. Eventually, even the US banks understand this. They will have to flip, they will have to go long, they will have to let price run just to keep COMEX from facing a delivery crisis. Which brings us to the final irony. They tried to save the dollar by smashing gold and silver. Instead, both bounced immediately. And now the dollar looks weaker than before because it couldn't even hold metal down for a full trading session. The illusion broke. The emperor has no clothes, the Fed has no bullets, and the cartel is running out of silver. This sets the stage for the final act. We have the signal from Xi Jinping. We have the vacuum pulling metal into China. We have visible panic inside the US State Department. And now we have price confirming the trend. The board is set. What's left is a personal decision. Where do you want to be when the announcement hits? Holding paper claims tied to a system fighting a geopolitical retreat, or holding the asset China is actively accumulating to replace that system? So here is the verdict. We've connected the dots. We saw President Xi call for a powerful currency. We saw the $34 arbitrage gap open and stay open. We saw Washington scramble to assemble a metals alliance to stop the outflow. And we saw silver recover above 86, proving the market psychology did not break. That tells us everything. Yesterday, the United States played its final card. They used the wash narrative. They dumped massive paper supply. They tried to scare holders, crush price, and defend the dollar. It failed. Instead, they put the most strategic asset of the century on sale. The paper price was smashed. China said thank you, and then China bought the physical dip in size. Now vaults in New York and London are draining at a pace that can't be sustained. The flow is eastbound, and once it leaves, it does not return. That's why emergency meetings are happening. That's why critical minerals suddenly matter. And that's why the language coming out of Washington has shifted from confidence to containment. They know what the math says. If this flow continues into March, COMEX becomes a shell. And if COMEX becomes a shell, the illusion breaks. Pax Silica, the assumption of Western dominance over technology and materials, ends quietly. Not with a crash, but with an absence. Which brings us to price. Silver in the West has only two theoretical paths. Either it collapses to zero because there is no metal left to trade, or it reprices higher to match the physical market in Shanghai. That $34 gap is not an opinion. It is pressure. And pressure always resolves. It will not resolve by Shanghai coming down. It will resolve by New York going up. The suppression failed. The dam is cracking. And once it gives way, the move will not be gradual. History doesn't announce itself in advance. It leaves signals. You've just watched them line up dots, so this is your second chance. The wash crash gave you a brief window to buy silver at a discount handed to you by the miscalculations of central planners. Do not waste it. Do not let the volatility shake you out. The squeeze is not over. It is just beginning. The financial military parade is about to start. You want to be holding the asset that sits on the lead float. Ignore the paper. Trust the flow. The East is buying. The West is panicking. The price is rising. 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 And it won't stop until the metal leaves the West, until the gap closes, until the flow of capital obeys the law of supply and demand. A broken bar. The price is rising. The price is rising. The price is rising.